Alright, welcome back everyone for yet another video, and today's video is going to be quite educational and interesting actually. I'll be doing one video per day throughout the whole of July, so please like and subscribe if you haven't already. Typically never ask, but please do. So, today's topic is one that I've been wanting to cover for quite a while. So, about a week or two ago, I made a live stream where we took the temperature on on the market. Basically, we did some reverse DCFs to see, okay, which stocks are over, under, or fairly valued. And I had a suspicion that the market was getting hot. You know, it's been running up a lot, all-time highs and all of that stuff. But turns out that most of the Mag 7 appears to be undervalued still. And only really Apple was overvalued. Now, keep in mind, these are not valuations. Today we'll not have actual valuations, but we'll be doing some DCF exercises. You will see what I mean in a moment. But if you look at this list here, from fairly over and undervalued, there's one stock in particular that stands out. And this is this one, Oscar Health, approximately 300% upside to just reach fair value. And that was quite intriguing to me. And I had no idea what Oscar Health was. Now, it has been garnering a lot of attention on social media, but I made this post on X. No, Elon, I don't want to. Okay, there we go. So I made this post on X where I shared the results of the exercise, and we'll be doing something similar today. And I asked, well, who can explain why the market is disrespecting Oscar Health so much? Like, even if I assume 0% growth, meaning they will not grow for 10 years in a row, and I also dilute like heavily, like I think it was like 15-20% per year, it is still like almost a double just to fair value. Like, it was completely insane. And if I assume a 50% revenue growth for these 10 years, it is undervalued by 360%, and this was so crazy. But since I didn't know Oscar Health and I never studied the business, I never valued it, I turned to X and see like, well, what could be the reason? Because 0% growth and still like 100% to fair value with heavy dilution, that's very, very rare. And a lot of people were beating the drum on Oscar Health. Some people mentioned like, well, they're heavily reliant on the Affordable Care Act. There's a lot of subsidies that are at risk. Now, the big, beautiful bill has been passed through Congress, I believe. I'm not really keeping up, but I know that there's been some buzz about the big, beautiful bill. And if we look at Oscar Health today, it is down 17% on the day. Seems based on that some other company pulled their guidance. Whatever. Not too important to what we'll be doing today, but it's still quite an interesting stock. Even though it's down 17% today, if we zoom out to year to date, it's still up 25%. So, I mean, this stock has been zooming, like, it's been doing really, really well. But it got me interested. Just seeing the results here got me interested. So that's what we'll be doing today, and see if we can get any smarter and how to approach equities that are heavily disrespected by the market. Now, again, I can't stress this enough. This is not a valuation of Oscar Health. This is a reverse DCF exercise, basically. So we have our model here without inputs except the historicals. So it seems that in 2024, they grew their outstanding shares by 20% and their revenues by 56%. So the first thing we need is to dilute the outstanding shares, because it is highly likely that they will continue diluting if they diluted 20% in 2024. Now, if you actually know the company, you will be able to be a lot more accurate than I will be here. I'm just going to make some assumptions. So let's do something like 15%, 3 years, 10, and then maybe 5% for the last 3 years. Something like this, okay? Now, next, we have revenue growth. Or like even accounting for no cash flows, just looking at the cash position and the debt, the fair value is actually $7. Like without any cash flows for the next 10 years, just looking at their cash and debt, we get a fair value per share of $7. So which is basically a bit more than half of where it's trading today. So as we add some more assumptions to the revenue growth and the free cash flow to the firm margins, this is going to look very different. But first, let's do the explanation of our discount rates and our terminal rates and how that will impact this exercise. So when you do a reverse DCF, you kind of want to, instead of starting from the inputs and getting a fair value, you start from where the stock is trading and you try to reach, okay, what is the market pricing in? Like, how do we reach $16 per share or $16.82 per share? Like, how do we reach that? And that's why it's called a reverse DCF. You basically work backwards to see, okay, well, for example, the market might be implying 3% revenue growth, 5% free cash flow margins, and you get to 1682. Now, I made those numbers up, but just so you can get an idea. And when you're gauging the market's expectations of a stock, it is very important to only use market implied expectations. So when I make a discount rate, I don't include any business specific risk, because that would mean that I am being subjective, like I am imposing my own ideas of what the risk to the cash flows are for the company. So when you're doing a reverse DCF, try to remove all your own assumptions as much as you can, and try to stick to only market implied assumptions. So that's why when I do a reverse DCF, I only use the implied equity risk premium and the risk-free rate. Now, quickly explaining that, the risk-free rate in this case is the 10-year treasury yield. Basically, what can you get risk-free today instead of investing in equities? And as of the yield of yesterday, it is 4.23%, which is quite high. And the implied equity risk premium is basically by taking the market today and using forward-looking assumptions from Wall Street, for example, you can get an idea of the risk appetite of the market. So we know, if I asked you, do you want to invest in Oscar Health and get 4.23%? Or do you want to get 4.23% risk-free from the 10-year treasury yield? Most of you would say, yeah, I will take the risk-free alternative, because investing in Oscar Health, it's a stock. It is a lot more risky. Why would I settle for the same yield as the 10-year treasury yield when I could get that risk-free? Why would I invest in a stock when the 10-year treasury yield is risk-free, basically for the same return? The question then becomes, okay, well, how much more percent do you require in order to take on the risk of investing in stocks? And that is the equity risk premium. Basically, how much return do you require on top of the risk-free rate to invest in stocks? And I won't be going into that in a lot more detail, but Aswat Damodran explains how you can calculate that. He also publishes the equity risk premium per month, so on his website, so you can go and get that. But for the month of July, I believe it is 4.3%. Let me check. Let's be certain. So if you go to his website here, you can either calculate it yourself or just grab it if it loads here. Apparently I have very slow internet. There we go. So 4.21% is the current equity, 3.94%. So the risk appetite actually increased. Like, people are willing to take a risk on stocks for even less returns as of July compared to June, which was 4.03. Now it's 3.94. So we add that. Let's see, 3.94. And that's what I settle. I don't include the business specific risk when I do reverse DCFs. So sorry for that lengthy explanation now, but I think it's still important to understand, because this will matter a lot, and I will show you why. So let's start with the exercise that I did on the live stream. So I assume 0% revenue growth. So as you can see, the revenue stays exactly the same up until 2034. They don't grow a single dollar for 10 years, which is basically unlikely that they won't be growing a lot. So then we need free cash flow to the firm expectation. Now, I haven't looked at the composition of their cash flows. I don't know what this 10% is. Is it a fluke? Is it a lot of... Is it due to working capital? I don't know. I don't know the company's stock, but if we assume that they can grow that, I think what I did during live stream, I wrote 15%. So let's just do that and see what we get. So assuming that they can have 15% free cash flow margins and grow at 0% and still dilute quite heavily for 10 years, there is 210% upside to fair intrinsic value. Now, let's say that they can't get 15% free cash flow margins. Let's just do 10, the same as they did in 2024. We still have 121% upside to fair value. And when you look at this without knowing the company, without knowing the risk, you're like, oh my God, this is completely insane. Basically, there was a similar situation in PayPal a while back when it was trading at 60, or probably it's still trading at 60. I don't know, it doesn't seem to move. But when PayPal was trading at 60, I made a valuation. And similarly there, if you assume 0% growth for PayPal, it would still be fairly valued at like 60. So the market didn't expect the company to grow at all. Now, why is that? Well, in PayPal's case, I think the market is underestimating their ability to reinvigorate themselves. I mean, they have new management, they have new verticals, they're launching ads, they are increasing their margins. While the growth might not be what it once was, they are still growing. So 0% growth assumptions is basically completely ridiculous for PayPal. Like, it's not a growth machine, but I mean, they are growing. So in PayPal's case, you could find a reason, but what is the reason for Oscar Health? Now, I do not know exactly, as I haven't studied the business, but there seems to be a lot of risk tied into the Affordable Care Act and stuff like that, since they are an insurer, like they deal with health insurance, and that will impact people's abilities to utilize health insurance. So there is some external risk to the company, but is the risk really worth 0%? Revenue growth as an assumption? Like, even less, like the market is expecting them to basically go negative by quite a lot, because even at 0%, there's still a double from here. So that's what you need to ask yourself as an investor when you're valuing this kind of company. Like, you really need to account for all the risks to the business. Now, let's do some assumptions, some comparisons. So for a very stable and high quality business, let's use S&P Global, for example, where the cash flows are very predictable, I introduce very little business specific risk. So that might be 0.8% up to 1%. If we introduce that, we go from 120% upside to fair value with 0% growth and 10% free cash flow margins. We go from 120 to 97, basically. Okay, but that is assuming that the risk to acquiring the cash flows is quite low. How about more or less higher risk? So let's take Tesla, for example, and what I use for Tesla. Tesla, there's a lot of uncertainty to them acquiring future cash flows. Like, we don't exactly know when robotics will actually start to scale and what kind of margins there will be. We don't know how the robotaxi will do over time, how much market share in the ride-hailing business robotaxi will do. So there's a lot of risk. So for Tesla, it might be something like 2.5%. If we introduce that to Oscar Health, we still have 64% upside just to fair value. And that is assuming 0% growth and 10% free cash flow to the farm margins. Now, this is getting like quite crazy. You're like, what is happening here? So let's do something where there's extreme unpredictability. So let's take a market maker. You guys might know that I'm interested in Virtu Financial, which is a market maker. And because they're a market maker, they're heavily reliant on market volumes and volatility. And since no one can predict markets, there's a lot of uncertainty about future cash flows or future cash generation. So for something like Virtu, I basically use more than double. So let's do 5.5% business specific risk, assuming that it's extremely volatile to get future cash flows. We do that, we still have 35.66% upside to fair value. That is assuming extreme risk. I mean, we are looking at a discount rate of basically close to 14%. And that is also including heavy dilution. Like if we do some more normalized dilution, like something like this, I mean, yeah. If you know the business, you can probably make better assumptions about expected dilution. But in this scenario, we go from 266 million shares to 686. So not quite a triple, but a bit more than a double, like 250% roughly. But still, this is assuming extreme business specific risk, and we still have 35% upside. So something very strange about this stock. Now, let's assume that the risk is actually accurate. Let's assume that, yeah, it is actually probably around that 5.5% business specific risk, which leaves us at a roughly 14% discount rate. But the company is actually expected to grow. It's not expected to be at 0%. Now they grew 56%, but what can they compound over a 10-year period? So if we just assume 20%, we get 252% upside to fair value if they are able to compound at 20%, assuming still this very extremely high risk. Now, let's say that, well, it might be ambitious with 20%. Okay. There are probably some bulls there that said, no, they're going to compound at 30%, or there's some bears like, no, it's going to be 5%. Like we're doing different scenarios here, okay? And you draw your own conclusions according to your understanding of the business. So let's have that, 10%. It's still a double from here. Today, like fair intrinsic value as of today, assuming that they go from 9 billion in 2024 to 23 billion, or basically 24 billion in 10 years, there is still like upside of 110% to fair value. Like something is very fishy here. And to be honest with you, I do not know this company. I'm very intrigued in understanding more, but this could be one of the biggest risks to rewards opportunities in the market, like that I've seen. Like this could be absolutely crazy. Now, let's assume that it is actually 15% instead of 10% free cash flow to the firm margins, like they're able to grow that. With 10%, we still have a triple. Let's assume that it's actually 20%. We have 400% upside to the fair value, assuming this extreme risk to the cash flows. Now, if we assume Tesla level risk, you have basically 652% upside to fair value, and that is still assuming extreme dilution. So you draw your own conclusions. I'm definitely intrigued in studying this business. I don't know if I'll get around to it, but very intriguing to play around with the numbers in an Excel exercise. Again, this is not a valuation. This is an Excel exercise to try to see how different inputs affect the fair value of the stock. But I mean, even assuming like extremely bad scenarios of 0% growth, 10% free cash flow to the firm margins, extreme risk, you still have one of the best risk to reward stocks. Like even assuming extremely pessimistic scenario, you still have like extreme upside. So that's it for today's video. As I mentioned, please consider liking and subscribing. I'll be doing one video per day throughout the whole of July. And if you want to access equity research, my personal portfolio, thematic portfolio, stuff like that, research.typefcapital.com. All right, everyone. Thank you so much. See you tomorrow. Bye-bye.